Kim, Raman, and I are pleased to welcome you to the May edition of the Cafe Seminar Series. Today, Vikrant Vig from London Business School is presenting quality and productivity in aircraft sales, why fire sales discounts are overstated. It's joint work with Julian Franks, Oren Sussman, and Gunjan Seth. So the presentation will be followed by a discussion by Karin Thorburn from the Norwegian School of Economics. So thank you again, Karin, for accepting to be the discussant. That's an important task for all of us. As usual, there will be 40 minutes for the presentation, 20 minutes for the discussion, and 15 minutes for Q&A. So this time we decided that questions would be allowed during the presentation. Vikrant is eager to get our feedback during his presentation. So we'll do that. So just raise your hand if you want to ask, or unmute yourself if you want to ask a question. Vikrant, the screen is all yours.
So thank you so much for inviting me to present this this paper. As Laurent mentioned, I prefer it I'd like to have it in the seminar format, just so that confusion stemming primarily from my presentation doesn't build up over time, and then we're on a different track. So that's sort of it's almost like mark-to-market type of a type of an approach. So please just unmute yourself and ask. So that so as Laurent had mentioned, this paper is co-authored with Julian Franks, who's teaching at the moment and so could not be here. Gunjan is in the audience, and she's ready to take all the tough questions that you may have. She's our stellar PhD student. Oren is from CEPR School of Business. So let me jump in what this paper is about, and as you can see, the title has changed a bit, Karin, from what you had, but the content remains the same mostly. So that thank you so much for agreeing to discuss the paper. This is, you couldn't have asked someone someone better for this paper. So when I learned that you were discussing it, we were sort of delighted. So let me just give a just a background of what this paper is about in the interest of everyone. So this paper is sort of going back to this issue of the fire sale discounts that have been documented in both the finance and the economics literature. And now sort of, if you look at a lot of models in macro finance model, but also just general macro models, right? They take this fire sale and inefficiencies associated with fire sales for sort of granted, because the studies that have been done, they sort of find these enormous effects, large magnitudes of these inefficiencies. So let me explain what essentially the fire sale is. So fire sale refers to this forced sale of asset. Okay, the asset it's a forced sale because the seller is distressed. And it's a fire sale because there is this view that when this asset is being sold, the best user of the asset is somewhat not participating in the bidding process. So there's an inefficiency associated with this fire sale, that the asset moves from a higher productive user to a lower productive user. And this is sort of, clearly a bad thing, because then the asset is not going to be generating the same amount of payoffs or value, whatever you want to talk about it. Okay, so that's basically the view coming from the sort of Schleifer-Wishny side of things. There are, of course, other elements of it. These fire sales also generate negative externalities and can have effects on, can send firms into firms and economy into downward spirals, as in the Kiyotaki and Moore. So collateral prices go down. This could drop in collateral prices further affects the pledging capacity of firms, which then has an effect again. So sort of it can have these externalities. But I was mentioning earlier, what is puzzling is these large effects. So Palvino, which was the first paper on really tackling this, looking at the airline industry, which is what we are going to be looking at here as well, documented discounts ranging from 15 to 35%. There are these two papers. One is job market paper and then a follow-up paper, depending on, distress definitions, whether they're Chapter 7, Chapter 11, or distress based on some accounting measures, 15 to 35%. John Campbell, in his recent AER paper with Stefano Giglio and I forget the third person, Parag Pathak, documented discounts as high as 27% for the real estate market. Okay, so when houses are forced, when there's forced sale of houses, they generate a 27% discount. Now, if you look at these discounts, they're quite big, and they raise this issue: is why aren't people renegotiating? Like, what's happening? Why aren't markets coming in and somehow preventing these losses taking place, right? So if you look at, for example, an aircraft, an average aircraft in our sample based on 1991 prices is transacted around 10-12 million. I'll show you the data on that, right? So we're talking about a huge amount of value being lost out here. Moreover, it's also puzzling that these magnitudes are so large, given that if you look at the aircraft industry, the analysis that's been done, there is the presence of Chapter 11 procedure in place, so which allows for a patient sale of assets, right? There is a reorganization procedure. So despite that, you're getting such large fire sale discounts. It's sort of is an issue that one needs to think about. Why is the cost theorem not working as hard as it should, right? What's preventing bargaining from taking place? Now, what I should also mention is that I'm talking about real assets in the sense of housing and aircrafts, but people have also looked at fire sale discounts for financial assets, and they found that for sale of financial assets also generate discounts lower in magnitude, about 8%, but different studies have also okay. Now, this is an important variable, fire sale discount, and I'll talk about how it's quickly calculated just so that everybody's on the same page. But a lot of design of the bankruptcy system is based upon ways of mitigating these costs, right? How should we make sure that the fire sale discounts are not large? Now, how is the fire sale calculated in the literature? It's basically a hedonic model. What's a hedonic model? Well, let's take the case of real estate housing. What you have is you have a lot of transactions taking place every year. So you have prices at which houses are transacted, the characteristics of the houses, the zip codes where they're located in, and you can put all of these in a regression framework. And what comes out of this is sort of a calibrated hedonic model, which says if you put in this model will give you the beta hats of, so you have log of price as your dependent variable, and then you have these independent variables which have characteristics and year fixed effects and lots of other things, and the R square comes out quite high in these regressions. But once you calibrate the model and you get the beta hats, what it says is you can basically, using this model, predict what the true price of this asset would be based on this hedonic model, and then you see at what price did this asset transact. Okay, and the difference between these two prices is basically your fire sale discount. That's essentially the fire sale discount. Okay, I've already mentioned this. Why is cost theorem not at work? But so I'll skip it. But I wanted to highlight that these magnitudes in real assets are quite large, even in the case of real estate. The John Campbell et al. Paper documenting high discount rates and why is such a thing happening. So what we're going to do out here is, one of the contributions of this paper is to decompose this fire sale discount into some into sort of what we think are three subcategories. And what we want to understand is that, yes, it is quite large, but what is really driving it? And what comes out as the first point that we learn from this analysis is that there is this unobservable quality of the asset, which seems to explain a significant portion of this fire sale discount. So what do we mean by the unobserved quality out here? Is that when an econometrician is running a regression analysis based on characteristics and trying to use that to calibrate a price, there are these omitted variables, which is, say, one doesn't know how well maintained a given house is, and things like that. And of course, if it's just an omitted variable which is not correlated with this distress variable, right, it doesn't really matter. But what we find is that assets that are sold by distressed companies, it'll become clear, in our case, aircraft that are sold by distressed airlines tend to also have lower quality, and we'll show a way of backing out what that quality is. And after we control for quality, we find that that somewhere between 40% to half of the discount is explained by the quality correction. So the fire sale discount comes down from 20 some odd percent to about 12-13%. We also then check. So what we have as a unique feature of our data set is that we are able to actually, so so we are able to measure this misallocation issue, the Schleifer-Vishny misallocation. We can take a stab at that issue to see if it's indeed the case that assets that are sold by distressed companies are being misallocated, right? If they're moving to low productivity users, and the price differential, that the fire sale discount is essentially reflecting that lower valuation from these next best user of the assets. So we can actually look at that because we have aircraft usage at a very at the aircraft level, their flying hours and things like that, and I'll talk more about it. So we can actually visit that. And what we find is that the fire sale discount, after controlling for quality, I mentioned is lower, but that fire sale doesn't represent a misallocation. We don't find evidence that these assets on average tend to be misallocated. If anything, what we find is that these assets, the delta, that the firms that are emerging from this are actually going to be stronger. So I'll talk about about that a bit later. But just to summarize it, what we find is that there's a quality element of it which is quite significant. There doesn't seem to be element of this misallocation on average. And what we call the residual fire sale discount is basically a liquidity component, that driven by basically an ex post transfer, between the buyer and the seller, driven by this need for immediacy. So it's not misallocation, just a pure liquidity effect. Ilu.
Vikrant, can I come in here? This
Please.
is very interesting what you're doing there. I'm sort of a little bit puzzled by your second point, the misallocation problem, because I mean, that's the basic core of the Hart-Moore et al. Theory of the firm. So you would want to argue that in fact a firm is profitable if and only if it really uses its assets in a unique way and does better than the second best user. So if you had told me, yeah, of course, there's a large, what you call misallocation discount, I would have said, wonderful, then Hart-Moore is right, and this is why these firms are what they're doing. Now you're telling me the misallocation is small. Does that now mean that, in fact, we are using a wrong simplified version in Hart-Moore by arguing that managers are specific to the assets they're using and therefore create value?
Yeah, I would say that we don't have evidence of manager specificity. So you're right that changing the manager or the owner of these assets doesn't seem to be creating, at least in the airline industry, any inefficiency. Okay, so these are, American Airlines is owning some aircraft, United Airlines is owning some aircraft. If they have to sell it in a distressed way, these aircraft can be used by similar productive users and be redeployed on different routes, and it doesn't really create that kind of an inefficiency. So the answer is, like if you take the Hart and Moore, right, the friction there is that the second period cash flows are not. Yeah, there is something specific. There is some in
Hart and Moore, you basically take the assets away from the manager, and that is considered to be sort of value destroying. But that is a good thing because it's the managers who can create, or the firm owners in their simple word, the firm owners can use these assets best of all. And so then, of course, you get the liquidity discount, the liquidation discount they have here. And that, of course, also says how, I mean, what you seem to have here is a model of industry which has, at least locally, constant returns to scale. You can shift assets around without too much of an efficiency consequence, and that means firms can at least locally grow or shrink without too much of a efficiency consequence, which is different in spirit from Hart-Moore, I would think. No?
Yeah. So I think just to clarify on that, I think that's a great point. I think the way we are looking at this is, so in Hart and Moore, liquidation is an inefficient decision, right? The continuation value is bigger than the than the liquidation value. The L is, the L in the model is lower than the continuation value. I think what we are trying to make the point is that our sample of distressed transactions that we are seeing, what we're calling distressed, are economically distressed and not financially distressed firms.
Yeah.
And so I think the point we're trying to make is not a challenge to the heart and mood thing in the misallocation sense. What we're trying to say is that for the aircrafts, the low price that you're observing in the data doesn't come from financially distressed firms selling assets to, that efficiency loss. If anything, these are economically distressed firms, and the assets are then being allocated through the bankruptcy mechanism to more efficient users. So in our view, bankruptcy seems to be sort of a, a cleansing mechanism which reallocates assets to more efficient users. I don't know if I'm making any sense with that.
Yeah, that makes a lot of sense. Thanks a lot. It was very helpful. Yeah,
I think that's how I would classify that. Okay, so yeah, so the main results, the quality impairment explains a significant portion of the fire sale discount, no direct evidence of misallocation to lower productivity users. So the point I was trying to make in the set of results, and thanks Ilu for asking this, because this really clarifies it. The way we are interpreting is that the residual discount that we're getting is not driven by these firms being financially distressed. Assets seem to be, through the bankruptcy, channel to more efficient users, which is a positive side of you can think of this as a positive. Okay, I'm going to, there's a lot of literature which is not on the slides in the paper. We have that, including Karin's work and stuff like that. So I'm going to not spend so much time in giving, but there's a lot of literature on debt. Ilu's been involved in some of these models, which I just remember as a PhD student, all those models, when Ilu was asking me this question, they started coming. I remember Patrick teaching us these things, and luckily I have solved those models. When Ilu was mentioning, I said, yeah, exactly, I know what you're talking about. Anyway, let me, so data, it's the aircraft, so the price, there's a price database, which actually, I think, which ends in 1991, which is basically the Palvino sample. So we have prices on the aircrafts from that database. What we also have is we have this flight global database, which I was mentioning earlier, which has this granular level, flying hours and aircraft's measures of productivity, which we'll talk about, which allows us to track at not only ownership changes, but how these aircrafts are being used. Okay, so that will allow us to sort of come to this, issue of not only the quality measure, but also how we think about misallocation. And the bankruptcy filing for distress, etc., are just from the Lokpaki database. Financial data is from CompuStat. So I'm just going to focus. There's a lot of information out here. A lot of it is redundant, not redundant, but not interesting enough. So, just to give you a sense, the mean aircraft price in our sample is 11.54. So this is our sample of distressed aircrafts. Aircraft age is the average age of an aircraft is about 14-15 years, depending on, this is the full sample. This is the aircraft, which is what we're going to be looking at. It's being sold by major US airlines. Here, if you look at this is an interesting one. If you look at, for example, bankrupt airlines and non-bankrupt airlines, what you see out here is that the retirement age of the aircraft is lower for distressed versus non-distressed. These are just summary stats right now. We're going to examine this more carefully. Okay, but what's going to come out, is that when we look at the data, what we find are two things, and I'll show you some results related to that, which is that these distressed aircrafts, when you look at them, right, they tend to die early than non-distressed aircrafts, controlling for the age, etc. Right, so they tend to retire. Let's put it this way. I don't want to associate the concept of dying with aircrafts right now, but they retire. They retire early. All right. And if you also look at the total flying hours and things like that, and I'll talk about it, right? What we find is that there seems to be this productivity measure, or this flying hours, that the distressed aircrafts tend to fly less. okay, which tells us something about, maybe there is an element of quality, and we're going to try and see, we're going to try and look at that in a more careful way and try to see. Okay, so here's going to the effect of aircraft on let me just make it a bit smaller. So here's looking at the life expectancy, and I'll talk about how we actually calculate the life expectancy. So what you have on the x-axis is the age of the aircraft, right? And what you have are these three lines, which is basically trying to measure using a hazard model, trying to measure what is the life expectancy of a distressed aircraft. So here you have non-bankruptcy sales out here in the green. If the color is clear, these are regular sales. These are Chapter 11 sales in the red. And finally, in the blue are the Chapter 7 sales. So what you can see is that if you were to look at a distressed aircraft, which is 10-year-old,
Sorry.
the life expectancy. Sorry.
Just to clarify, the blue one are the non-bankruptcy sales.
Did I say something? Maybe my color is. So
your tables, your graphics show it to us. Don't worry.
Okay, very good.
We correct you while you walk.
Okay, very good. I hope I'm not colorblind. Yes, sorry. Apologies. The green one is chapter. Thank you, Kunjan. The green one is chapter 7 sales. The blue one is the regular this thing. So what you can see out here is that if you take any age, right? What you can see is the life expectancy of a regular aircraft vis-a-vis, say, a Chapter 7 aircraft or a Chapter 11 aircraft, right? So all this thing, it tells you that the overall, if there is a difference in the life expectancy. So what I'm going to show you are some results around this, and we're going to try and then use this in a hedonic model to control for the fact that there's, that when the buyers were buying it, they actually knew what the average life expectancy was. And if you were to say, how do we control for this, and say, we are finding that all the aircraft that are distressed are dying or retiring early, then while they're in operation, they're also flying less. And we'll try and see how much of this information, if one, how much of this explains the fire sale discount, would be the way we'll go about the quality correction. So sorry, and thanks, Gunjan, for jumping in. I would have, Okay, so here's just the first regression trying to make that point, which is that the retirement age of a distressed aircraft is about 2 years, 1.985. So you can think about this as being 2 years lower. So the average aircraft, if I remember correctly, retires, in 28, 30 years. So if it was a distressed aircraft, it would retire 2 years before the normal aircraft. And you can then break down distressed aircrafts into Chapter 7, Chapter 11, and also pre-distress, which is basically a measure of distress, which is related to when was the bond rating of this firm was classified as a junk, so onset of distress. What you find is that Chapter 7 retirement age aircrafts that are going to Chapter 7, they actually have a 3.6 years lower life expectancy. Chapter 11 is 2.274, and so on and so forth. And so what we find is, just looking at this and controlling for the aircraft type, etc., we find that there seems to be this systematic element which is telling us that these distressed aircrafts are retiring early. Okay, and we're going to try and look at what's happening to these aircrafts. Why are they retiring early? And we will try and see, is it because these distressed aircrafts were not being maintained by these firms because they were cash constrained, which is what led to the lower quality, similar to sort of the debt overhang type of a problem, under investment in quality. And therefore the fire sale, when one controls for quality, is actually not going to be that much. So very similar, so in the Campbell et al. Paper that I mentioned on housing, right, they did point out this stuff, that there could be differences in the quality of houses which they could not observe, because these forced sales of houses were driven by deaths of individuals, and this was biased towards older people. Okay, so a lot of the people who were dying were older people, and maybe they were not maintaining the house properly. And so if you were to just do a hedonic model and come up with a fire sale discount and says, this is a house in Golders Green, in this zip code, it has 3 bedrooms, it could be it has some quality element to it. Now, of course, houses don't retire or don't die, and one doesn't know the maintenance expenditure. Unfortunately, we have this element where we can see aircraft retiring early, but we are able to this way indirectly try and see whether there is an element of lower productivity of these aircrafts which the buyers and the sellers were aware of. It's just the econometrician is not aware of, so attributes this to the fire sale discount, whereas this is just purely a quality effect.
Vikrant, can I ask you
Yes, please, Lauren.
clarifying question? So in some sense, one way of interpreting your results is that you're showing that aircraft are liquid assets, right? And maybe older, there's an element of quality, but essentially when an airline is distressed, it can sell its aircraft, at the relatively low discount, if any. But I would think another factor that's important is...
I'm not sure I'm agreeing with that, but we'll come to... Okay. Why don't you complete your question? Okay.
Okay, no, but yes. So my question was, it seems to me that also what might determine the liquidity of aircraft is the correlation of airline bankruptcies. So do you have summary stats on, like the percentage, when an airline goes bankrupt and sells, or is restructuring and sells aircraft, do you know which fraction of the overall market this represents?
Yeah, so what we do is, which I'll show you a bit later, what we look at is distress in the airline industry. So we have a way of looking at, so we call it booms and recession, very much in spirit to the Palvino analysis. And we show whether when the industry is in distress or the economy is in distress, how the fire sale discount varies with that. And I'll talk about that in just a bit. But I just wanted to say that we're not implying that there is no liquidity, that these assets are very liquid. In fact, I would say that there is an illiquid market out here, and there is a liquidity discount out here, right? And I'll show you that there is a discount of 10, 12% after controlling for quality, depending on which coefficient you prefer, right? So there is a liquidity premium, but it's not the 25, 26%. That there's a huge chunk of the quality that comes with it. And then the liquidity, we don't think this is driven by misallocation. It's not that Gunjan is selling the asset to me and I can only use a Porsche as a taxi, and therefore I'm just going to pay, based on that. Does that make sense?
Yes, it does. Thank you.
Yeah. It is the case that actually assets are not being misallocated, and therefore this is just representing an ex-post transfer, but not an ex-post inefficiency in that sense. Now, of course, we can discuss the ex-ante implications of this, but that's the basic. Yeah.
Okay. Thank you very much.
Can I ask a question about the interpretation of the result?
Yes.
So, could it be the case that this is about the control firms, the firms that are supposedly not in stress, are the ones that are selling airplanes that are of good quality, because they themselves might be trying to avoid entering distress. So they might not be in distress, but they're in pretty close to distress. And to do that, they actually sell really good assets. And then what you observe, like it's a kind of a perverse interpretation of your results.
Yeah. No, so I think that, so there's a lot of these issues around what the benchmark should be in these in such a study, right? And there's a huge, I think one should really revisit this whole thing on hedonic models in general, if they're the right way of approaching such a question to begin with, because even if you think about the way one calibrates it, liquidity automatically plays into the calibration of these things as well. Less liquid assets, there's less data, less reliable hedonic models. So there are lots of, but what you're raising is an important issue. What we're trying to say is that this differential that people are associating with with an inefficiency, right, and taking for granted, is driven by is driven by that there is this quality differential between these two groups. Okay.
Okay, I get it.
So it's more like that.
I understand that the benchmark is the question, but I think you also understand my question. What I was going to
absolutely, your point is that maybe this is even a bigger, like it's almost like, I think let me put yours in an extreme way. You're saying, what if the whole market is distressed in some ways or the other, right?
Exactly.
Then one would pick up a 0 fire sale discount, but that doesn't mean there is no inefficiency. I mean, am I putting your right?
Precisely.
And there is this issue of, which has not been tackled in this literature, an important issue of what's the right benchmark. So we're taking a sort of a step in this. We are thinking, and so I'm very much sympathetic to that question, and one needs to think about it. But I'm questioning these magnitudes in this study and trying to say, when we look at it, doesn't look like, yeah, it's driven by quality differentials across these two groups. Now, one, just to push this, I don't want to also just call this methodology totally rubbish by agreeing with you on that, right? So there's always, the truth is always in the middle, and so I just want to say that you can actually throw out, you can say, well, if it is the case that a lot of these are driven by firms that are being classified as non-distressed, but they are sort of distressed and stuff like that. So you can throw out in the sample of regular transactions and stuff like that. And you see that these models are quite stable in what they predict. So I just want to, so what I'm trying to say is that what you're calling the regular transactions, you can also put grades in that and say, this looks closer to distress than this group.
Exactly.
And what if I use that group, which is just a regular transaction? Does that change the robustness of the results?
Exactly.
And it doesn't. And so to give Palvino credit, there's a lot of, yeah. So anyway.
Okay, good.
All right. Okay, so where was I? Yeah, so I talked about the lower the retirement age, that these aircrafts are dying earlier. So there seems to be some element of this unobservable quality. And when I say unobservable, I'm not talking about a model of asymmetric information. I'm saying both the buyer and the seller were aware of it. It's just the econometrician who's basing it on his model is trying to calibrate it, and that's what's delivering this result. Okay, so this is basically looking at productivity as measured by flying hours. Okay, and I'll talk about the fixed effects out there and what they mean in English rather than in econometric terms out here. Okay, so what you get out here is that if you look at column 1 to start with, right? What you can see out here is that when you look at the flying hours, so this is looking at aircrafts are transacted, and there was a distressed aircraft that was transacted, and then you're comparing it with a non-distressed aircraft that is being transacted. Okay, and what we're trying to do out here is we're saying, let's try and measure. So there's a buyer operator who's buying this aircraft. Let's call this American Airlines. American Airlines has other aircrafts of this type in their portfolio already. They buy this aircraft, and what we're trying to see is that how the flying hours of this particular aircraft compare to similar aircrafts, same type and all that stuff of American Airlines. So the same operator, that's what we mean by operator fixed effects. And you can put in operator times year fixed effects. So you're looking at within the same operator in the same year. And what you're getting is consistently you're getting this pattern that these aircraft that are bought by these distressed companies tend to operate or tend to fly 10% less. They have more downtime in some sense, all right? So, you can put in different types of fixed effects. This is like putting in a simple year fixed effect out here. You have operator times year fixed effects, operator times time fixed effects. And what we've also done is operator times type times year fixed effects. So what this is saying is within the same operator, within the same American Airlines company, how does this distressed aircraft, the flying hours of distressed aircraft, right, do compared to other similar aircrafts? Okay, and what you find is that there seems to be this element that there's a 10% lower flying hours. And then of course if you look at chapter 7 aircraft, which is the aircraft that are transacted in, yeah, Christoph.
So is this within 1 year, right? The number of flying hours within 1 year, I guess. So
yeah,
is this
at the yearly level?
So is this something you see just after acquisition of the distressed aircraft, and does this effect go away, or does it increase over time, or is there anything you can say about the time dynamics?
We see this.
Because I could imagine that you buy a distressed aircraft. I could imagine that maybe in the first year you need to do some, I don't know, renovations to the aircraft or some other work on the aircraft, and that's why it flies less in the first year, and then maybe over time this difference goes away. Or
yeah,
so I was wondering if there's anything you could say about that.
Yeah, so what we have is a variable in the database called parking, which tells you how much is the aircraft parked, and that sort of gives this, if there's maintenance going on, it'll show up as, this time this is the time it's parked. This is conditional on flying. Okay, so so there is this element which is a lot of these aircrafts, when they are distressed, they're parked in some deserts or whatever it is, and some of that generates the lower under maintenance. But this analysis at the moment is looking at conditional on flying, what is the lower productivity? And I think, Gunjan, did we look at the time dynamics of this? And I can't remember what we had, but I know this is the average. If you could unmute yourself, and if you wanted to add something to that, that would be great.
Yeah, so we see these effects throughout the remaining life of the aircraft. So they don't go away after 5-6 years of the sale.
Yeah, but I don't, yeah. But I think we can do a plot as well, Christoph, to see, you know, I think what you have in mind is the time series stuff. And I think, yeah, we could.
Yeah, it might help disentangle different stories.
Absolutely. That's a very good point. Yeah. Now you can see out here in column 3, for example, is that you again break the distress into these 3 components, which is, so Laurent, I'm just assuming that I have 55 minutes. Is that okay?
Maybe, so we have a discussion afterwards. I mean, we have a discussion.
Okay, so I'll finish in 50 minutes and then keep 5 minutes at the end. Is that okay?
Yeah, that's fine. Yeah,
I'll take 10 minutes. From the 15 minutes, I'm taking 10 minutes for the Q&A as we go along, and then 5 minutes we can keep for very good.
Perfect. Yeah.
Okay, so what you can see, if you break it down into chapter 7, chapter 11, again you see that, you know, in chapter 7 you see you know, aircraft that were liquidated. You know, if chapter 7 is related to the extent that this is telling you about the extent of distress, it's 14.4%, and it's about 10% of that. Okay, so here's the final one, which is looking at the total flying hours of these 3 groups out here, and I hope I get the colors right this time. Okay, so these are this is basically looking at the total flying hours, and these are residual, so you've partialed out all, you know, so you're comparing the same type and you know, all sorts of different things. But I'll show you all these graphs, the tables a bit later. But the message out here is that if you look at these total flying hours, you see out here, this is the one that is sold in chapter 7. This is the one that is sold in chapter 11, and these are the regular transactions. Okay, so I'm calling this regular, and you can see out here is that the entire distribution is shifting to the left, which is telling you that the total flying hours of distress aircrafts tend to be lower. So controlling for the type, if I look at the entire cycle life, right, the total flying hours are actually lower. Is that clear? So putting everything together, so what comes out of this is the following: that now you can actually see where the total flying hours are lower. You find that actually total flying hours tend to be lower. If you look at the pre-distress period, these aircraft look quite similar. It's only after distress where you start seeing these, you know, onset of distress, and after that you start seeing you start seeing differences in quality. Okay, so what you see out here is that if you look at the pre-distress period, actually there is no differential in the pre-distress period. All 3 look pretty identical. But where the difference comes out for the total flying hours is in the post-distress period. In fact, it's the time that the aircraft spend in distress which leads to this lower discount. So what this is saying is that, so the time in distress here is measured as, you know, the onset of distress is defined as the, you know, bond rating downgrade. And then what happens that some of these distress companies go through chapter 11, some of them go through, so some of them recover, some of them go through chapter 11, and then some of them go through chapter 7, right? So what comes out is that the greater the time that the aircrafts are going to be spending in distress, the lower is their total flying hours, all right? So now, if you break it down into the time spent in chapter 11 and chapter 7, you find that this difference in quality is coming from this pre-distress period, not in the chapter 7 and the chapter 11. Okay, so it's just that the aircrafts are spending more time in distress when they are which end up going to chapter 7. But okay, so it also reinforces in some sense this under maintenance type of an effect coming from the distress of these firms. So it's you know, it's just, you know, you can think of this as a dead overhang problem, as I said earlier, that these managers are less willing to invest in maintenance or do, you know, sub quality maintenance. Okay, does the same pattern hold for other aircrafts? You know, I showed you that, you know, when I look at the operator fixed effects, these distressed aircrafts are operating at a lower productivity. What about the other aircraft that these companies are buying? And what you find is that you don't see such a pattern. Non-distressed second-hand aircrafts don't seem to have this pattern, which is what we see for distressed aircraft. So if you put the same operator times, you know, if you look at the same operators, in my story, it was American Airlines is buying a distressed aircraft, but it's also buying non-distressed aircrafts, right? You only find this quality discount or the lower productivity coming in from the distressed transactions and not from the regular transactions, suggesting again that it's probably to do with something lower quality, and they're just paying a lower price because they know going forward they'll be able to get less out of this. Okay, now I'm going to, you know, I think I've told the story. I just want to quickly go to the fire sale discount and see how it's calculated, talk about misallocation, and then we'll give it to Karin to criticize or whatever. The approach. Okay, so the empirical methodology is just mimicking the Palvino analysis. What we're going to do is we're going to use a hedonic model, characteristic-based approach, and what we're going to do is we're going to estimate a hazard function, a Cox model, which is basically trying to give us this idea of which is going to give us this life expectancy essentially. Okay, so you know what we're going to be able to calculate at every point in time. You know, if it's a 10-year-old aircraft, what's the probability of this aircraft dying the next year? And not dying it. So it's going to be like a binomial model, and then you can calculate based on that what the life expectancy is based on these hazard rates, which are basically going to be the probability of distress. So that's going to give so at any point in time, the aircraft is going to be distressed, would have some age. You know, if it's a 10-year-old aircraft, we have that it's already lived for 10 years. And then going forward, we have this differential hazard rate for distress versus non-distress aircrafts. And we're going to try and we're going to correct for that, and we're going to try and see what it does to the overall discount. So here's without the quality correction. Okay, just looking at all distress, you know, you can think of this as the Palvino's 1997 paper. Okay, all distress pooled in. What you get is that there is a 16% discount. Okay, and once you do the quality adjustment, so this is basically accounting for the fact that these aircrafts have lower productivity while in use, but also they tend to retire earlier. What you see is that the fire sale discount goes down from 16% to roughly about 8%. This is what I meant by quality impairment channel roughly explains 50% of the raw fire sale discount. So just taking into account that these aircrafts are not giving the same flying hours, you see that that seems to have a significant impact on the fire sale discount. You can further break down distress into Chapter 7 and Chapter 11, and what you find is that, you know, if you look at Chapter 7, distress was about 25%. If you control for financial buyer, it's 28%, blah blah. And then you control for the quality, you do the quality correction, you can see that the discounts have actually come down to about 10%. All right. So when you take into account the fact that these assets have differential usage, lower usage, it lowers the fire sale discount. So just to summarize all these things in one table, the raw fire sale discounts are out here, 16% for the whole sample, Chapter 11, 28%, Chapter 7, 28%, Chapter 11 around 16%. Okay, and different definitions of distress. Once you adjust for the quality, right, you see that these discounts come in the range of 8 to 10%. So from that, you know, 18, 20, 15 to 25% now suddenly, okay. And they start actually resembling very similar to what you get for financial assets as well. Okay, this is about 8 to 10% is what has been documented. And the quality element, which is the differential between these two, which is what we're calling contribute, is high for Chapter, is about 18% for Chapter 7. So these assets that are transacted in Chapter 7 actually have a much larger fire sale discount, much higher quality, much higher under maintenance compared to these other aircraft. Isaac, something popped up and then went away. Do you want to ask that question? I'm not very. Maybe I can look at the chat.
Sure. I didn't want to interrupt you. So
you want to do that after the discussion? Should we do that?
Yeah, absolutely.
I want to show a few things if that's okay, and I have absolutely. 5 more minutes. Yeah.
Yeah, absolutely.
Okay. So This is the question I think Isaac asked, or someone asked about this. I forget now. Maybe Lauren, it was your question about recessions and how it varies with the business cycle, perhaps. And what we see out here is, this is again trying to, if you look at, this is the raw fire sale discount calculation, and what you can see out here is that once you look at distress, there seems to be an extra discount in recessions, an extra 8% that is tagged in recession. So when the industry is distressed, there seems to be this element. However, when you control for quality of these aircrafts, right, the fact that these, they do the quality correction the way I described earlier, you see that there is still a discount, but it's actually much lower. So it looks like these aircrafts that are being transacted in recessions are also of different quality, and once you take into account. So there is this, the composition of aircraft also changes. So yes, in the raw, you do get this effect that there's a higher fire sale discount, but that's driven by, lower quality aircraft that are being transacted. The very good aircrafts or good companies tend to be Total flying hours of distressed aircraft sold in recessions, which is consistent with the previous table, is lower. Recessions tend to be, there's a different composition of assets that are being traded in recessions. Let me go to the second point, which is an important one, which I was mentioning, which is, so what I've shown you are some tables trying to make this point that there seems to be, looking at the fact that these aircrafts are retiring early, while in use they're actually operating at a, generating lower flying hours for the same type, etc., suggests that there is this quality element, and when we control for it, we get some mileage out of that. It bites into the fire sale discount. Let's look at whether the remaining fire sale is driven by this misallocation, and I already hinted at this earlier. We don't see this. We don't find evidence on that. And what we tend to find is that, if anything, the assets are moving from lower productivity users to higher productivity users, and therefore, we don't think of this as a misallocation in that regards. Okay, so here what we're looking at is the flying hours, and what we're going to be doing is we're going to be running this. Okay, I misspoke something. Maybe Kunjan has responded to something. Okay, these pop-ups distract me more than anything. I will take this. Okay, so when we look at these, so we're looking at, what we're looking at is, we want to look at the post-sale users productivity. So what we do is we measure the residuals at the aircraft level, controlling for these fixed effects, types, etc., and then we aggregate it to get what the productivity of this user is based on the individual aircrafts that this is. So productivity of an operator is measured by averaging these residuals across all the aircraft that are flown by the operator. And what you find are these two graphs are going to just summarize everything, and then the regressions are just going to be showing you whether this is significant or not. So what this is saying is that if you look at the buyers of distressed assets, aircrafts, and what it's saying is that buyers of distressed aircrafts, and you can see the color in your screen, but you can see that these distributions, I'm not just talking about the means, these distributions, the residuals look quite similar, that the buyers of these distress on average are not different from the buyers of non-distressed assets. So on the buyer side, it's the same buyers who are buying these, distressed aircraft. So if there's a 12-year-old, for a certain type of an aircraft being transacted, distressed versus non-distressed, the buyers are the same. If you now look at, the difference between the buyer and the seller productivity, which is what I was mentioning, the delta, or whatever you want to call it, right? You see that the difference between the buyer and the seller productivity is positive in majority of the sales, which suggests that, if anything, for the distressed aircrafts, it's not the buyers that are different, it's the sellers who are operating at a lower productivity. And what this is happening is that these aircrafts are moving from lower productive users to now what are the optimum users in some sense, right? So there is a positive delta as opposed to the misallocation in the Schleifer and Vishny.
Vikrant, if you could, Vikrant, you have two more minutes, so if you could,
I'll just okay. This is just another, I'm just again showing you in graphs, and this is very similar to. So this is looking at, what about the aircrafts that are surviving Chapter 11, and what you see out here is that we actually have a very a decontracting. What we find is that aircraft that survive Chapter 11 tend to actually, if anything, be better in terms of how they tend to do in terms of their flying hours, etc. And what we interpret this as, some of the view that people have had, that what Chapter 11 allows these companies to do is it allows them to decontract. So there was certain wage contracts, for example, which were inefficient. The unions had negotiated wage contracts, so they go into these bankruptcy Chapter 11 and they emerge as a stronger firm, renegotiated the old contracts, their leases, etc., and they're able to be more productive. So that's what we have. Finally, just in the interest of time, financial buyers. So if you look at the coefficient on financial buyers, you see that there's an extra fire sale discount that comes from the fact that the assets are now moving to these leasing companies, and a lot of people have interpreted these leasing companies as being industry outsiders. What we find is that actually these are not outsiders. These are not the final user of the assets. These are market makers in this model. What they do is they buy aircrafts, and what they do is they allocate it to more efficient users of assets. So they're not the final users of these assets. And what they basically charge is their market making. Okay, so it's a very competitive, many leasing companies that are out there. So leasing companies in our world is an outcome, is not a misallocation as such, but it's sort of a something that has evolved to fix this inefficiency. So maybe I'll talk more if in the last 5 minutes. So let me just quickly summarize what we have. Is what we've tried to do out here is we've tried to dig deeper into what is this fire sale discount that has been documented in prior literature. And when we decompose this, we find that it seems to be, quality seems to be a big portion of the fire sale discount, and the remaining fire sale discount after controlling for quality does not seem to be driven by misallocation. That of course doesn't mean that the misallocation is not possible, but this view that these fire sales have these huge inefficiencies and assets are losing so much in value seems to be maybe a bit exaggerated. Is how we were thinking about it at this point. I'll stop here and hand the floor to Karin.
Thank you, Vikrant, for this very interesting presentation. Karin?
Thanks for asking me to discuss this paper. This is obviously an area where I've had a big interest for a long time. So I'd like to start talking a little bit more generally about the fire sales and the basic idea that was proposed by Schleifer and Vishny in their 92 paper. In their paper, there is a financially distressed seller that needs to sell, and I think it's pretty much a firm they're talking about. Industry rivals could use the assets efficiently, and they are the highest valuation buyers. But because of industry contagion, all the rivals are cash constrained at the time of the sale, so they can't participate in the auction. Of course, the outcome is then that a less efficient industry outsider wins, because that's the only one who can finance the purchase, and that implies a welfare loss because the assets are inefficiently allocated. And the second result is that the sales price is below the value of the assets in their best use, and this is the fire sale discount. Now, you can think of sales of going concerns where you have the entire operations, and of sales of individual assets. And if we look at fire sale discounts in going concern sales, of course, a potential solution to the problem proposed by Schleifer and Vishny is that industry outsiders actually hire an industry insider to manage the firm. And in that case, the industry outsider should be willing to pay pretty much as the industry insider. But in their paper, that's not possible. Another alternative is that the cash-constrained rivals use some type of project finance to buy the assets because they can generate this high value with the assets. If we look at the empirical evidence on fire sale discounts in going concern sales, there are pretty much only two data sets. It's the one that I exploited with Espen in our papers on auction bankruptcy. And there we see that the prices that are paid for going concern sales or in going concern sales, don't seem to be affected by industry distress and liquidity, and that pretty much rejects fire sales in these of these going concern sales. And we also observed that the post-bankruptcy operating performance in the company that have acquired the firm is at par with industry rivals. So there is no evidence of inefficient allocation here. Hotchkiss and co-authors have a more recent paper where they explore sales of firms in Chapter 11, both through the reorganization and through 363 sales. And they also conclude that the redeployment of the firms are efficient. They find similar recovery rates across firms sold in auctions and across firms reorganized independently. So then what about individual asset sales, which aircrafts pretty much are? Well, of course, to have a discount, you need illiquid markets and time pressure from the seller's side. In liquid markets, we would expect discounts to be relatively small. But in illiquid markets, it may take time to find a high valuation buyer. And of course, if the seller then is time constrained, it won't have this time and it may just agree to a transaction at a lower price. So the evidence on discounts in distressed asset sales is pretty much like Vikrant already reviewed, that there is a discount. There are many papers on this, and the size of the discount ranges depending on the sample and what type of assets are sold, but pretty much between 10 and 25%. Now, it's important to keep in mind that a low price in a distressed sale isn't necessarily a fire sale. I mean, we have the entire industry can be in economic distress. Maybe there is a downward shift in demand, maybe industry profits are low, and actually there are no higher valuation users than the ones buying the assets. We may still see low transaction prices, but this is not fire sales. A fire sales has this notion of that there is someone else out there that could use the assets better, but they just are cash constrained, and that's why we get this discount. You know, I think an interesting thought experiment is, for example, COVID and you know the major decline that we've seen now in airline traffic. Is this a more permanent shift down, or is it just temporary? And if there are low transaction prices today, then are those fire sales or not? Of course, to examine fire sales, you need to figure out this fundamental price that they're going to have a discount from. And there are different methods. I mean, the Ramesh-Shapiro paper, they use asset replacement value. We looked at estimates, valuation estimates by industry specialists. And then the most common technique is to use some type of hedonic price regression. So of course, the discount is never any better than the preciseness of this hedonic model. And then, as Vikrant explained, the fire sale discount is the difference between the actual transaction price and this estimated fundamental value. The paper of Pulvino, which this paper builds on, examines aircraft sales. And there are these first two steps. First, he estimates this hedonic price in the price regression, where he controls for all the information he has that could drive the price: aircraft type, age, engine stage, and then quarters. So there is a time dimension. And then he regresses these residuals from the price regression on proxies for seller distress. And his key findings are that financially constrained airlines sell aircrafts at a pretty large discount. These discounts are greater in Chapter 7, and we see financial buyers paying less for any type of seller, basically. So what does this paper do? Well, it improves on the hedonic price regression in Pulvino. And the key idea, which I think is quite clever, is that distressed owners underinvest in maintenance. Yes, there is a regulatory level of maintenance, but there is a big variation in how much you can spend. And this under maintenance then lead to lower asset quality, which is going to be reflected in the price. I think this paper provides very strong evidence supporting this notion. Aircrafts that have had distressed owners, they have shorter expected life. before they are retired, and they lower future utilization in terms of flight hours. So after showing this carefully, they add these quality controls to this first stage hedonic price regression. So you can see here, it's pretty much Pulvino's regression plus the quality variables. And of course, that's going to change the discount because now the residual is different. And the key finding is that the quality adjustment then reduces the fire sale discount. It's pretty much half of what Pulvino showed, and there is no difference any longer, depending on whether the seller is in Chapter 7 or Chapter 11. Financial buyers still pay less though, and that's true from any type of seller. And then there are some additional results about the reallocation of assets, which seems efficient. And this is similar to what Maximovich and Phillips showed in their 98 paper on planned sales of Chapter 11 firms. And then they also show that financial buyers reduce the time it takes to sell, so they provide immediacy. There is less underutilization and downtime of aircrafts before being sold to financial buyers. However, these buyers, they do redeploy the aircrafts to higher productivity users. So no inefficiency there in terms of the use. So the conclusions, I think, are just that the fire sale discount is lower than previously estimated once you make these quality adjustments. And there is no evidence of misallocations of assets sold in distress. And it seems as if financial buyers or leasing companies get the convenience yield for this immediacy. That's the lower price. My view on this paper, it's very well executed, it's polished, it presents a convincing ID. The fact that distress leads to under maintenance, I think it's clever. They have good empirical proxies for quality through life expectancy and flight hours, a large sample, intuitive results, lower fire sale discounts, efficient reallocation of assets, and the role of the leasing companies, and lots of robustness tests, and then it's well written. So I think my quick summary is just congratulations, Vikrant. Nice paper. Of course, I need to think a little bit more around it. So one reflection that I have is that these are asset sales. These are not going concern sales. And asset sales, I said before, then the two important criteria are how deep are the markets, what's the liquidity, and how stressed is the sell, how quickly does it need to happen. So I would be very interested in learning more about the depth of the markets for aircraft, because I don't know that much about aircraft markets, and the paper actually doesn't say much. It refers to Pulvino saying he says there is no auction, but I remember the M&A literature always said there was only one buyer because that's the only thing that was presented publicly. But then once people started going back reading background of the merger sections in SEC filings, we learned that there was actually pretty intense auctions going on before that final bidder is presented. So any information you could have on the depth of the market for aircrafts, and I think some of these issues have been touched on already in the comments. I mean, how does the transaction volume vary over time? Is the market flooded by aircrafts when sellers are distressed? Are many airlines distressed at the same time? What fraction of the fleet do these distressed airlines sell? Is it just one kind of plane or is it 10? And how large is the second-hand market compared to the delivery of new aircrafts? Because of course, this is a dynamic stock. How large is the turnover relative to the stock of aircrafts, and how many potential buyers in terms of airlines are there out there? I just know very little about it, and to me it seems that this would be an asset where liquidity shouldn't be that bad. That's my intuition example. And of course, then to learn more about the sales process, exactly how does it happen, and how long does it typically take to sell an aircraft? Anything that you could tell us about that would be interested. And since they're brokers, I'm guessing there are some type of negotiated auctions for aircrafts as well. Another issue is, of course, that the price data ends in 1991, and I'm wondering, is the discount still the same? So has the aircraft market become more liquid since? I mean, this is over 30 years ago since it ended. And my sense is that there are many more airlines today. There's been a lot of new aircrafts delivered. The fleet is bigger. Maybe there's just more transactions going on. And what impact does this have on the discount? And of course, many of these distressed airlines are in Chapter 11, and Chapter 11 hasn't been the same. We've seen a big change in creditor influence, and that took place pretty much when this sample ends. So creditors have much more influence over the process today and actually use auctions more frequently. And I'm just wondering if this has had any impact on the sales of aircrafts as well. I should say distressed sales, I guess, of aircrafts, because it's not the aircrafts themselves that are distressed. And my final comments relate to the role of the leasing companies. I think that's very interesting that you, and I think that you emphasize them, and I think you could actually spend more time on them. One thing that I was curious about is if their role varies over the business cycle. You know, for example, do they get bigger discounts in recession, even if others don't do? And do they step up and buy more often? I mean, how often? I saw it's actually a pretty large fraction, about a third of all transactions involve a financial buyer. But is this time invariant, or is there actually a pattern in how they offload those assets? It also surprised me to see that financial buyers are more common in the non-distressed sale. If their role is to provide immediacy, I mean, why do we have fire sales? Because a distressed seller has a rush to sell. So of course, then you would think that that's the seller who really needs the financial buyer. Now, bankruptcy may provide a relief from that need for immediacy. But then on the other hand, if you have time to search for a buyer, your discount should be lower. I mean, that's sort of the intuition we have in general with market liquidity. So I just think it would be very interesting if you could provide more information, and I'm sure you could run some regression just showing who is the buyer, when is it an airline and when is it a financial buyer, and are there particular patterns there? Because as I think you should use, it should be the distressed sellers outside of bankruptcy that have the highest need for immediacy and therefore have the highest need for them. So I'll stop my comments there. Overall, I just think it's a great paper, and I'm happy I could be the discussant and got a chance to read it carefully. So thanks.
Thank you, Karin, for this insightful discussion. Vikrant, would you like to respond?
No, just thank you for a great discussion and the compliments. But I totally agree with you. We need to talk a bit more on the institutional side about the depth of the market that you were mentioning, and I think we can do some work in describing that. The leasing, I think we could do some more. We did some analysis on leasing. What came out was this. Didn't come out as these leasing companies being a negative thing. If anything, what came out was this view that if anything they help lubricate this market, right, and so reduce any inefficiencies were there. But you're right in pointing out that these 41% and 18% numbers that you had on the slide, digging a bit deeper into it and understanding exactly. Yeah, but I just wanted to say that there's so many leasing companies out there, such a competitive market, right? That this view that these financial buyers are, is representing a misallocation, which was initially the view, is probably not right, and it's this convenience yield and market making type of message we wanted to put in the paper. But I sort of agree with prices do end at 1991, and it would be interesting to, and you don't know how many times we've tried it with different companies over the years, and it's just very I don't know, for whatever reason, this is, for ships, we do have a long time series, but for aircrafts, for some reason, we're not able to get it. If someone has contacts, we would be very thrilled and to explore it further. But I do want to add that our productivity data, the flying hours, etc., that actually goes in till 2018. 2016, if I'm correct, right? And we can probably get it, we can extend that as well if we were to pay more. But the patterns are very similar out there between Chapter 11 and Chapter 7 and things like that. And sorry, distress and non-distress. And then you see that there is this quality element that is quite. But you're right that maybe overall the discount could have gone down. But what I wanted to say was the message was not to say, aircraft. We believe aircraft is a liquid market. But what was puzzling was that in this market you're finding these such high fire sale discounts, right? Something must be happening, and we wanted to understand that, and that is what is driving it. You have not only it's a liquid, it's a fairly liquid market perhaps, but also you have Chapter 11 type procedures which allow you to patiently wait for the buy. It's not like it's, you just file for Chapter 11. There's an automatic stay. And so despite that you're getting such big discounts, what could be the reason is what we wanted to explore. So that's where we were coming from. But thank you so much.
Can I just add? I think you're touching on that in this industry, even waiting to sell, you might have to park an airplane, and it seems as if it's quite costly, and maybe that's part of the discount. And I think that's true for the ships as well. I mean, you have a paper on arrested ships, so that's also very costly to have a ship in arrest because it ages even if it doesn't operate.
Yeah, we have some back of the envelope calculations exactly on that. What it, like we talk about, it takes about 18 months or something to sell an aircraft, and what does one have to do in that time period? What are the costs and stuff? Those are sort of estimates we've got from the industry to come up with the costs. And then we say, how does the 10% discount to the financial buyer look like when you take those costs in? And it looks like, it's pretty, yeah. So
Vikrant, we have actually a related question by Christophe Spaniers. It's in the chat, but Christophe, if you want to ask a question directly, yeah.
I guess it relates to that discussion, but my question was whether you know anything more about, like, what is the type of under maintenance that we should be thinking of, right? So what is happening to those planes that they become less productive afterwards? Because it should be something related to my previous question. It should be something that's permanently impairing those planes, right? So I was also thinking about parking. I've read quite a bit about these planes being parked and that the conditions in which they're parked is quite important. So I was wondering if you have any sort of data or any stories for what's happening here.
Yeah. So we have some of these stories in the paper, and I'm sorry I didn't get to talk more about it, but we spent a lot of time talking to these appraisers and trying to understand. And this quality element, we were trying to understand what is exactly about the quality. And a lot of times, stories that have come out, it is things like you switch engines, for example, you swap engines in aircraft. So you take so the engines that the aircrafts have are going to be different. Something about quality of the interiors came out quite a lot, but Gunjan, probably you can remember some more of that came out on the quality discussion. But all appraisers are talking about that quality is a big aspect of it, because we were saying that there's so much regulation out there, so there must be, but there is a minimal amount of regulation, as Karin said, and then there's a lot of variance around it. And this swapping of parts, etc., is what drives this stuff. I should also mention that when we talk about under maintenance, right, they're also, these are also contracts that you give to companies essentially, right? And there are these, good quality German companies that are going to be maintaining it. No, I generally mean that. And then there are some, maybe Indian companies.
So is there any data on accidents or safety issues afterwards? Is there any logs of hazards or accidents?
No, we don't. That's what I'm going to say.
There is accidents, yeah. So like basically there's like a whole industry for parking aeroplanes, which of course has been very busy in the last 2 years.
Yes, these are deserts possibly, right?
In Tucson, Arizona, basically.
Arizona deserts and some in the UAE. You just park it out there. You need,
Maybe busy is not the right word.
So Vikrant, maybe a different experiment would be to compare across industries So for example, if you had a gold company, in a gold mining company, there is nothing to be impaired. You know, the quality of gold doesn't change with bankruptcy, with financial distress. So you could look at different industries where the asset is very specific to that particular industry versus where it can be used across sectors or it's much more liquid. And then you could compare what the discount is and whether it's related to quality or something else.
Yeah, I think that specificity of, cross-section tests, which varies on the specificity of assets, would be an interesting, would be something to, I would agree with that. So we have done some initial analysis on this, and I don't know, I can't remember, and but we had these wide body aircrafts and narrow body aircrafts, and one are more liquid than the other in the sense of it's very much in spirit of what you're saying. Redeployability is the word I want to use as opposed to specificity, but it sort of speaks a bit to that test, which is some assets are very easily redeployable in other ways, and others are not. If you remember this railroad paper of F.E. Ben-Melek, his job market paper had that, similar spirit. So we were trying to do, I don't remember, Gunjan, could you remind me what we got there? But we looked at, but I think that your point is right. We should, it's an interesting cross-sectional to come up with. I don't know whether we could get data on gold in general. Of course, gold prices are there and stuff like that, and I have to think more on it. But I think we could do something in the aircraft with the airline data.
There are cases about gold companies like bearings, and also there is data on gold companies. So I'll send you a case, which is quite an interesting case.
Okay, that'd be great. Yeah. For diamonds, it works the opposite way, just to let you know, because there's a lot of asymmetric information. You're not even allowed to open and look into, there are these diamonds in every pouch, and you say this is what's being auctioned, and the moment you open it and you don't buy it, it sends someone that, oh, this person is an expert and is able to value it, and that collapses the whole market. So, but here in these assets where asymmetric information is less of an issue, you're right. But
okay, so we'll take one more question from Elu van Taden, and then we'll stop.
Can I just ask whether one can tell another story, Vikrant? I mean, the story is very nice and very convincing, of course, but just to sort of to construct a strawman. So you are potentially more than a strawman. So you're, of course, emphasizing the quality difference at the time of sale. So there's this distressed seller who has not invested enough in the aircraft, and therefore there's a quality adjustment, and the discount is there. And you measure this though with post-transaction data like flying hours, like retirement age, etc., etc. Could one make the argument that, in fact, hypothetically at least, that the aircraft quality is identical at the point at the time of sale, and what happens only happens afterwards, which would be consistent with your arguments? For example, buyers could buy these aircraft for different reasons. So, for example, as a marginal aircraft, you would use it just occasionally when there's peak load, and you would park it otherwise. Or you, and in exchange, you would maintain it less, and you would probably even run it down more quickly because you don't need it as core assets. An argument of this sort, I think, could potentially work, but I'm not sure. And that would, in fact, then mean that the quality discount is not there at the point of sale, but is rising later on endogenously through the strategic motive of buying by the buyer.
Yeah. So, I mean, this is a very good question. This is a good question that we've spent some time thinking about it, and we have, I think, even maybe a few lines in the paper on this as well. So the way so let me just restate, just in the interest, for myself and also for the others, what you're trying to say is that, it's not that the aircraft that this American airline company is buying is a poor quality aircraft. Is that they have this alternate use of this, they need something for, which needs some flying hours or whatever it is, but the alternate use is, what, we're getting something cheap. All right, we would have not bought it at the full price, but you're giving it at the 50% discount. I could use it for vacations or whatever it is. I'm making it up, whatever that measure is. And the point is that these aircrafts, first of all, the way they are allotted, right, is you know, the type, for example, we have this route information on where these aircrafts are being utilized in general. Okay, now we don't have exact route at the aircraft level, but what happens is that think of a portfolio of aircraft that you've kept for your New York, Boston, Washington route. Okay, and then you keep using those. And so this aircraft would be allotted to a given route like that. And then you won't have an aircraft which is of better quality just being underutilized in that type of story that, you know, so you know, as a given aircraft gets worse, right, it makes sense to use the better quality aircraft on those routes so that there's lower downtime and things like that. So the re-optimization that you would do with this new aircraft would not generate this particular good aircraft being left, right? It'll be any other aircraft from your portfolio.
Yeah.
Probability of it being any other aircraft is, doesn't make, you know what I'm trying to say? It's like
sounds very reasonable. This type of control would kill that story. Yeah.
So that's my. But
I think we need to conclude for today. So thank you very much again to Vikrant, Karin, and all the participants for a very lively seminar. I think we liked the format, which is a little bit different from what we had in earlier seminars, but I think it worked well. So the next seminar will be Cafe Seminar will be held on June 8th, and the speaker will be Maria Sunta Giannetti, and the discussant will be Laurent Frézat. So we hope that you all will join us again in 1 month. And in the meantime, I'd like to thank everyone again, and hope to see you again very soon.